Ladies and gentlemen, good day and welcome to the Alicon Castalloy Limited Q4 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the session concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CVR India. Thank you, and over to you.
Thank you, Tanvi. Good day, everyone, and thank you for joining us on Alicon Castalloy Limited's Q4 and FY23 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, Mr. Veera Babu, Group COO, Mr. Shyam Agarwal, Chief Marketing Officer at Alicon Castalloy, Mr. Andreas Heim, Managing Director of Alicon Castalloy, and Mr. Rajiv Gupta, Head of Domestic Business of Alicon Castalloy Limited. Mr. Vimal Gupta will cover the financial performance for the quarter, following which Mr. Shyam Agarwal will walk us through the operating highlights. In order to share the developments in both the global and domestic markets, Mr. Andreas Heim and Mr. Rajiv Gupta will provide insights on these areas. Following the comments from the team, our Group COO, Mr. Veera Babu, will give us a brief summary of the quarter gone by and cover the strategic imperatives. Thereafter, we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good afternoon to all our investors. Thank you for taking the time out to join our earnings call. I trust that all of you have had a chance to review our earnings documents, which were shared on 16th May. As we have indicated earlier, 2018-19 was the best year in the last few years for the global auto industry. Our assessment is that the domestic industry has reached a performance level of approximately 84% in the financial year 2023 of the level set in 2018-19, while the international auto industry is at about 88% level in calendar year 2022 of the base achieved. At Alicon, our revenue performance in the financial year 2023 is around 130% of the benchmark that we had set in 2018-19, clearly showcasing a different trajectory of performance when compared to global and domestic auto industry. This has been driven by the addition of new parts as well as the new customers. Our growth and transformation strategy over the last 5 years has been validated as we have reported our highest ever annual revenue of 1,405 crore in FY23. Even in the backdrop of significant volatility over this period. The envisaged business transformation involves a strategic focus on multiple avenues for growth, which we have categorized into 5 pillars. These pillars are: continue to scale strategic products in the IC business, addressing the opportunities from carbon neutral technology, including battery electric vehicles, hybrid electric vehicles, fuel cell and hydrogen cell technologies. Opportunities from structural parts or technology agnostic parts, which remain consistent no matter which fuel technology is used to power the vehicle. Non-auto business encompassing opportunities from sectors such as defense, energy, telecom, to name a few, where our competencies can be leveraged. Enhanced customer wallet shared through value add and combining products to offer our customers a one-stop solution. The progress we have experiencing can be attributed to the execution of our growth strategy. We have dedicated substantial resources to reshape our business model, becoming a more flexible and diversified organization that capitalizes on our key strengths. Our international team have been actively engaging with customers, fostering deeper discussions to leverage our expertise in design, research and development, and value engineering. Our proven track record validates the effectiveness of our processes and our reliability as a supplier. This is supported by the continuous increase in our order book and the acquisition of new and renowned clients. Moving on to the highlights of our financial performance for the fiscal year ending 31st March 2023. Alicon's best ever annual revenues of 1,405 crores in FY23 were higher by 30% year-on-year basis, significantly surpassing the industry growth. The revenue growth was driven by enhanced volumes compared to the previous year and start of production in certain new products. This positive trend was further supported by the improved contribution from our international subsidiary, Alicon. We also posted higher ever EBITDA of 157 crore, higher by 36% year-on-year basis. The EBITDA margin for FY23 stood at 11.2% against 10.7% in FY22, an increase of 46 basis points. New parts added with higher value addition have contributed to structurally improved EBITDA margin. Profit after tax of rupees 51 crore is higher by 113% on year-on-year basis. I am pleased to share that our board of directors have approved an interim dividend of 50%, equating to rupees 2.5 per share. This year we have witnessed an improvement in ROCE to 12.7% for the financial year 23 from 9.1% in FY22. Our long-term rating by credit rating agency CRISIL has improved a notch from A stable to A positive. I will now run through the financial performance for the fourth quarter. Total income of rupees 321 crore was flat on year-on-year basis compared to quarter 4 of FY2022. Further, this was lower by 12% on a quarter-on-quarter basis from rupees 361 crore in quarter 3. In quarter 4 FY23, our plant in India and Europe operated at a utilization level of around 65%. In the quarter, we witnessed a decline in two-wheeler volumes as OEMs reduced production schedules in order to transition products in line with on-board diagnostics, that is OBD norms. This one-time regulatory implementation had an impact on our performance during this quarter. Further, the volatility witnessed in last 2 to 3 years drove customers to increase the inventory as they moved away from just-in-time strategy. With the normalization of global supply chain, customers have moved back towards leaner inventory levels, and this readjustment towards lower inventory levels has resulted in one-time softness in volume this quarter. We also noticed that issues with semiconductors are yet to be completely resolved. While availability has improved significantly since this challenge first emerged a couple of years ago, there are still constraints in sourcing of semiconductors by global and domestic OEMs. However, our gross margin has improved, and this was supported by a decrease in prices of major raw materials and a more favorable product mix. We believe that input prices have passed their peak and are likely to decline moving forward. Despite some delays, we have observed a pass-through effect of previous input prices increases and a better product mix, leading to improved results. This has positively influenced our gross margins for the quarter, which was 51.6% in quarter 4 FY23 compared to 50.4% in quarter 4 FY22, higher by 118 basis points. In quarter 3 FY23, gross margin was 49.3%, and the quarter-on-quarter improvement in gross margin is 230 basis points, or over 2%. The improvement in gross margin did not flow through the EBITDA margins due to increase in power and fuel costs as well as other overheads, which have increased in line with the inflationary trend. Due to the initial stabilization requirement of new products, we have incurred certain costs upfront for new products in this quarter. As the product throughput is stabilized and volumes are enhanced, the unit contribution from these new products will improve in the coming quarters. There was also a settlement of one old claim from the customer, which resulted in one-time expense in the quarter 4. As a result, EBITDA was at rupees 33 crores in Q4 FY23 with the EBITDA margin of 10.3% as compared to 39 crores with a margin of 12.1% in Q4 of FY22. On the capex front, we have deployed 16 crores during the quarter and have deployed a total of rupees 82 crores during FY23. Our value addition to net block has significantly increased from 130% in FY2021 to 160% in FY2023. In FY2024, we envisage a capex deployment of around 90 crores. Coming to the outlook, following our highest ever revenue of 1,405 crore in FY23, we are poised to take the business to a newer heights and aspiring to deliver a revenue of over 2,000 crores by FY25-26. That is over a period of 3 years. Our confidence stems from the new orders which we have received and the discussions with the customers on new technologies and solutions. Notwithstanding the EBITDA margin performance in this quarter, we are confident for an improved margin outlook. Despite the 7C framework of challenges identified by us, including the post-COVID impact, the chip shortage issue, cost of new product and development, the conflict between Russia and Ukraine, global cost-based inflation, supply chain challenges, as well as the challenge from the recessionary environment, we have improved EBITDA margin for the full year. The increase in EBITDA level in FY23 over 22 demonstrates the positive impact of enhanced value addition and a richer product mix. As previously mentioned, our target over the next 3 to 4 years is to raise the EBITDA margin to 14% through a combination of growth initiatives and cost efficiency measures. In summary, we are focused on sustaining the momentum and endeavor to improve the financial and operational performance in the coming financial year. Our primary focus remains on enhancing margins, return ratios, and optimizing our working capital cycle. We are confident of delivering healthy revenue growth with a strong profitability growth in the upcoming fiscal year. On that note, I would now like to hand over to Mr. Shyam Agarwal, who will talk about operating highlights for the business.
Thank you, Mr. Vimal. Greetings to all of you. During the quarter, domestic auto industry witnessed moderate growth of 0.6% on YOY basis due to the OBD issues as well as the constrained chip availability. Within this, the bright spots were passenger vehicles, which grew 13%, and commercial vehicle, which grew 7% on YOY basis. The improved growth in PV was driven by increase in high-end segment, greater tourism activity, as well as new launches. In the case of commercial vehicles and heavy vehicles, factors such as increased infrastructure spend, mining activities, and logistics growth helped to drive volume. In FY22-23, Alicon has booked new orders aggregating 1,700 crore. With this, our total order booking has reached to 7,800 crore, which is executable over a period of 7 years from 2022-23 up to 2028-29. In last quarter, we have received further new orders from some of our global customers like Jaguar and Land Rover and Danfoss pertaining to products in the carbon neutral business. The commencement of supply for these orders along with the start of production across our aggregated orders booking will contribute to increase in revenue momentum. All of you would recall that we had announced one of our largest order wins for JLR e-Axle housing in August 2022. I am pleased to share that innovative solutions provided by Alicon in co-coordination with our European arm in close association with JLR R&D team has enabled project to progress on schedule with the start of production planned in the next year. From the strategy perspective, we are progressing well on our key pillars. Our value addition mix in key pillars did well in the fourth quarter as the share of carbon neutral business stood at 9%, structural products stood at 8%, and non-auto business stood at 8%. We will deliver balanced growth with improvement in all segments despite a volatile market environment. Another focus area for our value creation approach is to increase the value addition mix from our products for four-wheeler and CV segments. In FY23, we were able to reduce dependence on two-wheelers from 41% to 38% and increasing the share of four-wheeler business from 49% to 53%. In carbon neutral technology, our focus is on passenger vehicles, commercial vehicles, and export opportunities as we see a greater scope for value addition in these areas. We see good traction with the motor housing products for Tata Motors as they are dominating the passenger EV market in India. We are also seeing encouraging number in commercial vehicle segment as the parts we had developed for Dana are facing promising demand with continuous government support to develop cleaner public transport options. We also supply parts for three-wheeler products to Dana, which is again showing favorable demand trends. The export business is doing well as we are focused on increasing wallet share on the back of development of parts for customers such as Danfoss, Eaton and Scania. We are in discussion on new projects and nominations in coming quarters. Our major customers JLR in structural part business witnessed fluctuation in production due to availability of chips, but with their initiative to diversify supplies, we expect improved volumes from them in the current fiscal year. My colleague Andreas will walk you through the further development in the structural part, while Rajiv will cover development in the ICE and the non-auto business. On that note, I would now like to hand it over to Mr. Andreas Heim to throw light on the global business.
Thank you, Shyam, and warm welcome to all of you. I will briefly cover the developments on our international.
Sorry to interrupt here, so your voice is not clearly audible.
Can you get my voice now better?
I will reconnect your line.
Yeah, perfect.
This is the operator. We have the line for Andreas connected, so you may proceed now.
Yeah, thanks and sorry for the inconvenience. Thank you, Shyam, and warm welcome to all of you. I will briefly cover the developments on our international business. We are steadily emerging from the challenging situation witnessed in the calendar year 2022. Businesses in Europe are steadily adapting on the challenging circumstances and with some moderation in input prices, including gas, customs are now starting to operate plants at higher utilization levels. This has led to firmer indications for products being supplied by us, with revenues from our European facility growing 20% on a year-on-year basis. One of our key customers, JLR, has requested an increase in volumes for key part supplies. While semiconductor availability remains a bit of a challenge, we see better availability for high-end cars, which has reflected an improvement demand momentum on JLR for Samsung battery housing. Bosch, which is a tier 1 supplier, has also done well and added new customers for their offerings. One of their end customers has introduced a new larger model which has requirement of 2 housings per vehicle, resulting in firmer demand. In Europe, as the winter subsists, we see resumed demand for two-wheelers. This typically in volumes during the spring season has led to improved demand for structural parts from two-wheeler customers like KTM, Husqvarna and BMW. We anticipate this continue through the summer months. Further, with the easing energy costs, there is some relief for households from the sharp inflationary pressures, which can lead to better customer demand. Aluminum prices has also softened on the reduced cost basket should help our customers in reducing prices of the final products. Apart from the increased activity from customers, which we had anticipated and indicated last quarter, we also increased our customer interactions and are seeking to work with customers on products as well as on various solutions for adjustment products with several of our customers across OEMs and Tier 1 are working aggressively on new technology developments. The global business contributed to 21% of the total revenue during the quarter and 22% for the fiscal year respectively. Apart from the improved customer sentiment which we are seeing, we are also moving ahead with initiatives to reduce costs. We have received approval for the investment in solar panel, which will help us to reduce energy costs and remain more competitive. On this note, I would like now to hand over to Mr. Rajiv Gupta, who will cover the development in the domestic business for the quarter.
Thank you, Andreas. Good day, everyone. The Indian automotive sector experienced volume growth of 13% in FY23 on a year-on-year basis. However, this growth was largely front-ended and in the latter half of the year. There was some softness in growth, especially in case of two-wheelers, as it was affected by the regulations related to onboard diagnostics as the OBD. Fortunately, there was better traction of 25% year-on-year in passenger vehicles and 29% year-on-year in commercial vehicles due to reasons mentioned by my colleagues. For Alicon, the sales growth from passenger vehicle increased 52% year-on-year and commercial increased 59% year-on-year. The contribution from our domestic business stood at 78% during the year. Going forward, in the auto IC business, we are seeking to increase the portfolio of the critical parts. In case of Toyota, we anticipate volumes to increase towards the end of the current financial year with a strong market response with new launches of Hyrider and Innova Hycross. We are further in discussion with the market leader Maruti Suzuki on addition of further cylinder head businesses. Progress on these fronts will enable us to deliver on our strategy to enhance the passenger vehicle part in a revenue mix. In the non-auto business, we have further supplied towards our order of the prestigious telecom project under Atmanirbhar Bharat. During the quarter, we were awarded a tender from the Department of Defense for supply of wheels for the battle tanks and cylinder heads for the heavy-duty defense truck, for which we will commence dispatch in the coming quarters. On this note, I will like to now request our Group CEO, Mr. Veera Babu, to share his perspective on the performance for the year.
Thank you, Raju. Good day, everyone. Our FY23 performance represents a consolidation from the disruption of the last 2 to 3 years. We have stabilized our operations and we look to build on the momentum. One of the key achievements in FY23 has been the significant level of order booking, which will feed our growth in the upcoming years. As shared by Vimalji, our performance in FY22-23 is about 130% of the level of financial year 18-19, which was the previous high for the global and domestic industry. We will build on this further within the balanced growth in the business across our 5 pillars. Our confidence is built upon deepening of a client engagement by leveraging on tech, research and development, design excellence, and value engineering. We have demonstrated to our customers of our deep value that we can provide them as a supplier of repute. Another important element that we are focused on the deepest footprint on technology. We work on automating certain process of our operation, automate certain process of our operations. We have been highly proactive by working on advanced technologies, especially for the thermal cooling solution for EV segment. Another area of focus is to provide innovative solutions to our customers in the area of complex parts pertaining to the cooling solutions for motor and e-axle over traditional methods. We have also made progress in developing a 3D printing solution for sand mold, enabling our customer the ability to quickly convert design into prototypes, thereby compressing the product development lead time. We are also exploring friction stir building, which is highly recommended application in the area of EV for strong and high quality joints. This technology-based solution has helped us differentiate ourselves across the global landscape. We are also actively working towards increasing our sustainability footprint and have commissioned our captive solar plant in India, while installation of solar panels at our facility in Europe will be completed this year. These initiatives will meaningfully transform our energy mix. On this note, I would now request to moderate to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Yash Dalal from Sushil Financial Services. Please go ahead.
Yes, firstly, thank you to the management for this detailed breakdown of the quarter and year gone by. So just a few questions. Your vision was of 2,000 crore revenue and EBITDA margin of 14 to 15%. Are we on track to achieve the same? And when could we see this happen?
Yeah, yes. So for 2,000 crores, we are targeting by 25-26. So next 3 years to achieve that level. And definitely, as we were explaining in our previous Concalls also about the improvement in the margins. So we are expecting to reach around 14% in that year of 25-26.
And to add on, basically to achieve the sale of 2,000 crore, we are quite confident because if we see the portfolio for 25-26, we have noticed around 84% business that we have already secured. That is from the regular and the new parts what we have added. So for achieving that, we don't think there's any worry. Further, we are trying how we can materialize.
So only balance is now 15-16% is the balance, so that we are receiving a lot of new inquiries, RFQs are there, and a lot of new businesses under negotiation with the customers. So we are fully confident that we will be able to deliver these numbers.
And second point here is we are planning to increase as per a strategy where we get good margins. One is to reduce our dependency on two-wheelers and enhance our contribution with passenger and commercial. Second is to increase our portfolio in the carbon neutral, structural, and also to some extent the non-auto parts where we have higher margins. And third is to increase our portfolio in the global market where we can offer solutions and we can leverage over a competitive, basically a high good margin prices.
Okay, thank you. And so for these 2,000 crore revenue numbers, what would be like the revenue mix for your two-wheelers, four-wheelers, your new technologies like your EV, hydrogen, export, and non-auto?
Yes. So in this, if I talk in terms of our segment buckets, so two-wheelers would be around 31%, passenger would be around 40%, passenger would be around 36 to 40%, commercial would be around 20 to 25%. Non-auto, yes, it would be around 6 to 8%, something of that sort. And yes, little chunk we have kept with three-wheelers also because we see a good momentum picking up, especially three-wheelers in the EV space. And the good thing is, Alicon is also have entered in this space and is now materializing through developments what we did with ANA. Coming to the different portfolio mix which we categorize, that is our 5 strategic segments. At this moment, the visibility we see, we've already confirmed with our planning, roughly around 20 to 24% with carbon neutral path. IC would play around 60 to 65. Non-auto, I've already explained. Structure also is the area where we are aiming, and that is where we have added a parts with the Jaguar in the passenger vehicle. These solutions are really appreciated now with other players also in this space. And yes, we are doing quite good in the two-wheeler high-end bikes. So the good thing is, yes, we have this edge with our European space, with past developments through KTM, BMW, Ducati, which we have added last year. But now even in India, we are noticing the trend of high-end bikes are coming up. And that's the reason we are noticing the OEMs like REML, Classic Legends, that's Mahindra, and also Honda. They are coming up with a swing arm a structural portfolio. This also will further enhance our portfolio. But yes, we are planning to keep this portion from 5 to 7% because this is the area where I'm going to mitigate any risk because be a two-wheeler, be a hybrid, be a IC or be a electric, this path will remain common. So this also is an area where I aim to increase my portfolio.
Yes, important is that if you have heard that with the change in the sales mix, how it is moving. So earlier Alicon used to be having more than 50% contribution coming from the two-wheeler industry. So now this year we have gone down from 53% that was in last year, 21-22. So that has gone down to 46% in the last year of 22-23. And now, as per our planning, by 25-26, it will be in the range of 30 to 32%. So
okay.
The contribution from other sides like passenger and commercial, that is increasing that bucket.
Thanks very much for your explanation. Basically, we are aiming to increase our sales content per vehicle, per machine. Because I think if you see a two-wheeler component ranges from say 1 kg to say 3 or 4 depending upon the cc of the vehicle. But we have more opportunity when we explore a passenger vehicle or even a more opportunity when we explore a commercial. So that is what we are aiming to increase the sales per machine.
Okay, thank you. Just a couple of more questions. Could you throw some light on the revenue loss caused in Q4 due to these new OBD-RD norms? And what will be the impact of this in the next few quarters this year?
Yes, we noticed the impact. And this time we noticed the OEMs were very cautious. They didn't want it to repeat the issues what they faced when there was a transition from a BS4 to BS6. And that's the reason we noticed this very early in Q4 when they started. They have reduced their numbers. So our impact was roughly around 30 to 35 crores with this hit. And this is one time, what we know very well. This is just a one-time hit. Now, from April, we have noted, in fact, from the last 2 weeks of the March, we noted the volumes have picked up. And now the OEMs are planning to build this inventory and further grab them.
Okay. And also, what is the volume growth in FY23 and the impact on realization due to the fall in commodity prices?
The revenue growth, which we have noticed, which we have mentioned in the script also, we noted it was around 30%. But yes, we noted the commodity prices also have fallen down. And with that, we noted there was a hit of roughly around 50 to 55 crore. So this would be roughly around 4 to 5%.
Okay. And also, could you provide like a guidance on the growth expectation for FY24 volumes and revenue going forward?
So that I think in the last meeting also we have been approximately now at this moment we are expecting to grow by 15% the top line.
Okay. Okay. Thank you so much.
Thank you.
Thank you.
The next question is from the line of Raghunandan from Nuvama Wealth. Please go ahead.
Thank you, sir, for the opportunity. Congratulations on a strong FY23. First question was on the demand side. So there are two factors which are likely to positively support the growth for FY24. First one, you have a strong pending order book. Can you indicate roughly how much new orders can contribute to FY24 revenues? And secondly, one of the segments which I am hoping that should contribute to the growth is exports, because semiconductor supplies seem to be gradually improving, and companies globally like Volkswagen, Audi, they are talking about growth up to 15% in CY23. Even JLR has guided for 24% volume growth in FY24. So if you can throw some light on both these factors, new orders and exports outlook.
So yes, first is on new order booking. If you see, this year we are planning to book roughly around 700 crores from the new parts what we have added. This will basically contributed from the passenger vehicle and commercial vehicle segments. So if you see the total roughly around, yes, so greater chunk will be from the passenger and commercial vehicle and also from the structural parts and the EV parts what we have added. Talking about the global OEMs, how they are going to support, yes, the new businesses what we have added, especially from Jaguar. One is the order win which we have declared in August 2022 in last year. So this we are working very closely to materialize this effect. Further is last quarter we added one more part with Jaguar, and this we have explored one more opportunity. Ideally, we were focusing on a motor housing, battery housing, inverter housings, and e-axle what we added. So these were what we have added, what we were targeting. But we noticed, especially for the high-end cars, there are some structural parts also as an opportunity which we can materialize, which requires for process what we are into. So this is a good business what we added in last quarter with a heavy weight of roughly around 13 kg part, and also with a good volumes of roughly around 80,000 a year. So this is also with our strategy which we're aiming. So Jaguar is one with whom we are planning to increase our portfolio. Second is Daimler in Europe, USA, and also we now have started Japan. And good thing also we noted in last quarter we entered to even the China of Daimler with this portfolio. Apart from this, there are other players in Europe which is now, with whom with the products are in development right now. One is Scania. This is again on electrification. We have developed 7 parts up till now, which will go in the SOP in this year. Then we have got MAN trucks. These are into big parts which talks about capability and criticality what Alicon is able to deliver. So these are big flywheel housings of weighing from 10 to 30 kg. So with this, even we have a possibility to touch base other European, US and Indian customers. We're also talking big with, if we come down to US, it's Danfoss. So we have developed one part that was in 2 years ago. Now, with a successful development, we and the trust what we able to deliver, we're in discussion of a big orders. One order, yes, in last quarter, which you have noted in our script, which we have booked. Further, we have strong discussions of materializing other portfolio in EV space with Danfoss. So with this, we feel we have got a good opportunity to materialize the developments what we added, particularly from the global businesses. Apart from, yes, domestic, which already there, which you have noticed, with examples like Toyota, which is now picking up, then is TACO motor housings for Tata, then is PSA also is picking up. We are working on and so on.
So Raghu, if we conclude all this, so what we are talking about for the numbers of the next year, this means current year of 23-24. So this 15% is the what we worked out based on the earlier the schedules shared by the customers, especially the global customers, where we are more focused. So now, hopefully, because just now they are in the process of revising their schedules. Whatever you are saying that they are now revising on the upward side of all their schedules, like either we talk about Volkswagen or JLR. So hopefully, maybe in the next Concall or very shortly, we will be able to revise our numbers also based on their revised numbers we received in the coming month. Hello.
Raghu, do you have any further questions?
Thank you, sir, for the comprehensive answer. In other words, assuming underlying industry grows anywhere between 5 to 10%, and with the new orders coming in, of schedules happening, can we expect upside risk to our current expectations?
We hope so. Because unless we get some information in writing or some confirmed news from the customers, so it is for us also difficult to revise the number.
And sir, just wanted to check with you, just clarifying what you said. Two-wheeler FY23, the share was 46%. Is that correct? Can you how much was it for PV, CV?
Yeah, that it was correct. 46% the two-wheeler, and 21-22 it was 53% on the sales side. I'm talking about the sales.
Correct. And can you share for the other segments also, sir? PV, CV.
Yes, definitely. Yes. Can you share?
We see for the PV, so it was 35% last year. What we ended up, and the previous year it was around 28%. Even commercial, in the commercial also we got a increase of roughly around 5% and touching around 21 to 22%. Carbon neutral also we noted an increase. It was roughly around 7%, and more we have added with the value addition portion. So ideally we are more observing towards the value addition what we are able to generate from these segments. So on value addition, even the contribution was on a higher side. If we see non-auto, it was around 7%, and technology agnostic was around 7%.
So here clearly you can understand that how the sales mix is changing from the year-on-year basis, and that is as per our that we have planned earlier.
Absolutely, sir. And in terms of the investment in FY23, that was mainly relating to the captive solar plant, right? Some 27 crore kind of investment?
Not for that. The total project value was because it is on a partnership basis. So our investment was 5 crore rupees for the equity here.
Okay.
Other investment is for our maintenance capacity, then new projects of PSA, there we have made a huge investment, and the machining side, as well as because now new customers are adding up like Toyota or Maruti Suzuki or some other new customers are coming up. So their testing requirements, their quality requirements are very high. So we have to invest on that side.
Got it, sir. Just a last question before I fall back to the queue. Q4, you said that there is a one-time expense which was relating to One was with reference to a customer where a claim settlement was done. How much was the one-time impact in Q4?
So that is around 3 crores. So that comes to around 1% of the sales. So there was one issue was going on for last 3-4 years. So one-time settlement. So still not concluded, but we have made a provision for that. That's all.
Got it. So ideally, this should not continue in the coming quarter.
Yes. This is a one-time settlement.
Got it, sir. Thank you so much. I'll fall back in the queue.
Thank you. The next question is from the line of Rahil Shah from Crown Capital. Please go ahead.
Hello, sir. Good afternoon. My question is on the global business. You said you are looking to increase the portfolio, correct? So currently it is at 22%. Now, first I want to ask, is this global business, is it in general a better business compared to domestic, let's say for margins and profitability?
Yes, because if you see now, one is domestic business has become more a commodity. There are a lot of other players also, right? And nowadays, with so much of competition domestic market, the buyers are very price sensitive. So they are like the players who are able to give a lower rate, they will immediately shift to that supplier. So that we have noted, unlike previously where we noted the OEMs were looking for a long-term partnership. And also as we are moving ahead with new technologies, with new spend on R&D, we have also noted this not be more with this space, particularly a segment like two-wheeler and so on. And that's the reason now we are shifting to more complex and critical and bigger and bolder parts. And that also we see a big opportunity when we touch global. I believe if you see the commercial and passenger in global, it's a huge number compared to India also. So that's the reason we are trying to add more with the global businesses. And with that, we are now increasing our travels also for our global customers to bring this, to increase the rapport and thereafter to convert it into opportunity. Because we know very well, this is a time where we are OEM, we are Tier 1, we are aggressively working on new developments, be a EV or be any advanced technology when we talk about IT. And we know a supplier who is regular or very close in discussions can definitely grab this opportunity rather than who is just trying to have a exploring opportunities sitting long from the customer range.
Just to conclude your question, one is that because in India, the Alicon presence is on the higher side. So what we can conclude that maybe the business in India at saturation for the market, maybe based on the when industry grows. So on that basis, we can see the growth or some new parts are coming up, but or maybe some more opportunities in the EV segment. But on the global side, the market is huge and our presence was very small. So we have everywhere we have the opportunity. So the based on this, so we see the big opportunity on the revenue side as well as definitely the margins are better when we made a comparison with the domestic market.
What can this number be of the split from 22%? How much can you? How much you're targeting? The split of revenue between global and domestic. It's currently 22% of total revenues on a yearly basis.
Yeah.
So how much you think you can scale up?
We are aiming to increase it to around 40 to 42% by 25-26.
By 25-26, okay. And this FY24 top line, you said 15% growth. But what about the EBITDA margins then? Currently at 11%. How much? What is your feeling about that?
At least minimum 1% growth we can see in this coming year.
Okay. All right, sir. No problem. That's it for now. Thank you and all the best.
Thank you. The next question is from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Hi, thanks. This is Aditya from InCred. So, sir, what is the right way to look at this order book of 7,800 crores? I'm assuming most of the execution is in FY25-26. So, if you can explain how the order book would translate into revenues and how is this divided into the recurring order book or new order book, etc. And the other question on the margin expansion is that with this structural change in the business/revenue mix for you, is it the right inference that most of the margin expansion would be from the gross margins? And third question is on the capacity utilization, with us being close to 2,000 crores and most of the current capex being in maintenance and machining. Is it right inference that we would be operating close to 80% capacity utilization? And if yes, how are we thinking about adding more manufacturing capacity going ahead? Thanks.
Okay, first now on the order booking, yes, with the great success till now on new orders, we see there's an opportunity to book around 7,800 sales over 7 years. And this, if you talk about contribution, roughly around 33% would be from the EV packs where we were aiming, so that's a good sign. And this, again, with the recent parts, what we added, especially the big orders from JLR, around 6 to 7% would be a strong structural. If we see this in terms of the segment buckets, around 50 to 54% will be from passenger vehicles, and that is which you have noted, like Toyota, the new launches, what they have done, Hyryder and iCross. I mean, the acceptance is far better than anticipated, and even Toyota is now asking us to increase the capacities at the end of this financial. So that's a good sign which we want to materialize. Also PSA, you have noticed they have launched this vehicle, a good one with good competitive price. So this also we are trying to materialize, and this will even be for domestic as well as the global business, followed by Jaguar. The business is what we are discussed. A good chunk will be there in export to UK. And yes, on commercial, if we talk about Daimler, till now roughly around 20 plus us, what we have developed with them. One few being very complex and complicated. This will help us now to leverage this opportunity, and this is roughly around 18 to 22% of a total order book what we have done on this area. And also would be, if you see this, what we have booked, roughly around 50% is from the global business. So that is also a factor which will help us to increase our portfolio. So what was your next question?
So with this structural change in the business mix, is it right inference that most of the margin expansion which we are alluding to, that is from 11% to 14%, would be from gross margins?
Yes, well, we can see that at the end it will come from the gross margins.
Got it. And third was on the capacity utilization, where we are close to 60%.
Capacity utilization, we can't calculate theoretically like this, the way you are calculating, because the individual part depends on the size, criticality. So we need some different type of machines, maybe for some bigger size of the casting machine, or some different process requirements from the customer. So on that basis, we have to invest, and somewhere we have to do the automations. And as we are explaining that now every 100% business is coming, we are getting the machined parts. So we have to invest for the CNC machines also. So on that basis, utilization of 80% definitely, but we are expecting, because overall utilization when we are even at peak, that cannot go beyond 80 to 85%, because 15 to 20% we have to keep for the business fluctuations. So we can expect that utilization of maybe around 75%. That we can assume.
Got it. And sir, on the execution of this order book, so what is the right way to think about it? Whether most of it will be executed in FY25-26, or how should we think about revenues flowing from this order book on the execution side?
The important is that what Rajiv has explained, that out of 2,000 crore, 85% businesses already we are having the orders. Okay, so only now 15% that we can convert into around 300 crores. So a lot of new businesses are under discussion with various OEMs, especially on the global side. So I think there should not be any issue to deliver 2,000 crores by 25-26. And definitely, like earlier, this Raghunandan, he was talking about the additional, maybe some surpass the projections. So they may also happen, but we can't say at this moment. Totally depends on the schedules and how the market behaves in the future.
And if you see, that's the reason we don't want to be dependent on a single customer. And that's the reason we are with several customers with diversified portfolio among different segments, different regions. When we talk about exports also, we are there with US, we are there with Europe, UK, we added a major chunk. And now we are exploring further to increase in Japan and few opportunities which we explored in last quarter with China.
And one important more point I would like to add, Apurva, about we are more focused on where we are having the higher margin side. Because, when we are talking about 2,000 crore, and it is easy for us to even deliver more. Maybe we can talk about maybe 2,200 crore also. But we are focused on the parts, what kind of parts we are doing. So just for your information, last 1 year, the number of parts we have reduced from I think by 150 parts, 490 to 315. So approximately 175 number of parts we have reduced from our basket. Yeah.
So we are just trying to materialize and capitalize our resources on an efficient way, where even we can please our customers and we can increase our portfolio with focused customers and getting a good margins thereafter with the service what we provide. So that is what again which we are aiming to support our customer the best way. Because if we are going to touch upon various alternatives, definitely we won't be able to support equally to all our customers. That's the reason we have come up with these strategies, and we have noted this has worked quite well in this year, and we are very sure to materialize even a more benefit in coming years.
And sorry, Aditya, I think I was wrongly pronouncing your name.
Yeah. So my last question is on the working capital. This year also we've seen close to 60 crores being stuck in working capital, and with 90 crores of capex for FY24, how is the cash flow position considering we are looking at high double-digit growth for the next couple of years? So this 40 crores increase in debt, how do you think about the funding position going ahead?
So for this year, like based as per our budgeted cash flow planning, so hopefully we will be able to reduce the debts by end of the year. And on the other side, when we are talking about the increase in the working capital, so one part is that there is increased growth in the top line by 30%, that has also impact. And as well as there are some issues like when we are talking about some inventory corrections by the customer. So we build up the inventory, so you could see that some increase in the inventory has happened. So that will be utilized in the coming months, as well as some capital debtors are there. So a lot of new products we have developed and the invoicing was done for their tooling. So that maybe they started making the payment. So hopefully next 6 to 8 months we will be able to realize that amount also. That is approximately around I think 40 to 45 crores from the customers. So we are expecting by end of the year, by means March 24, we should be able to improve drastically on the working capital cycle as well as on the debt side.
Great. That's it from my end. Congratulations on this growth.
Thank you.
Thank you, Aditya.
Thank you. The next question is from the line of Dikshit Doshi from Whitestone Financial Advisors. Please go ahead.
Yeah, thanks for the opportunity. First couple of questions is regarding the revenue target, what we are having, let's say 15% growth and 1% increase in the margin. If I see our last 3 quarters performance, the revenue is going down, let's say 377 crore in September, then 360 and 320. Some of that may be also because of the reduction in the aluminum prices. So when you are factoring in 15% growth from the FY23 revenue, are you factoring in, let's say, if the aluminum prices go down further, or this kind of growth you are anticipating due to the visibility of the order book? So how do we read this?
So for this, that is a good question. First of all, we have already factored this commodity prices. So nothing, we are not banking on that, on the higher commodity prices. And like Rajiv has explained, the new order book. So in this year, there is a further increase in the delivery side of what new orders we have procured in the last 2 to 3 years. So those are the main growth drivers for us.
Okay. So you are confident of growth because last 3 quarters we have been seeing the revenue coming down.
Yes, so even we have touch base what the researchers are talking when a growth of the market for global as well as the Indian automotive. What we have understood is almost all the regions globally are talking about an increase. The good sign for us is Europe, as the energy costs have come down, and also the Russia-Ukraine war is about to come down the east. So we are hoping a good opportunity from a European location. This will support our exports to Europe and also a good opportunity to materialize for a plant in Alicon. So that is one, and yes, one second is on the new parts what we added. The new parts and the new business also what we added will go in SOP, and this will materialize sales thereafter.
Okay. Now, second question is regarding this order book, what we give. So let's say when so this order book from a client must be some rough estimates of let's say in FY26 they must be having some rough estimate that this much will be their volume. But it does impact sometimes due to the recession or any slowdown in the economy. So what kind of max deviation from the order that client give one can expect?
If you see for this, last year we anticipated roughly around to book around 500 crores from the new order wins, and we just checked the hit. We have closed roughly around 440 to 450 crores. So this was roughly around 85 to 90%. It all depends upon how volatile the market is, and few hit, yes, which we noted because of the OBD, because some of the launches were affected with the new the regulations from the government. And for some instance, we see even the SOPs, what initially the OEMs were targeted. In some area we noted it was shifting by a quarter and so on. But yes, the good thing is we are able to achieve, at least hit 85 to 90%. But going forward, we anticipate this will be more than 90% a hit rate to achieve that.
And secondly, on the customer projection versus reality, so we also see which all customers give us what schedule in the past and how much is the actual pickup by those customers. So whenever we make our business plan, we factor those numbers and then only we make our business plan. So we generally go more realistic when we make our business plan.
Okay. And just last one question. You mentioned that we are seeing the 3-wheeler EV also picking up. So is it so in three-wheeler EV? Is it the ICE guys are aggressive, or do you see even the new players are also coming, just like the two-wheeler?
It is both the cases. If you see the current ICE player who has also developed the EV vehicles, so that are doing good, and also new players are coming. So it's a mix. But still our thinking is whatever was the earlier ICE player, they will do good in the EV place.
Okay. Okay. That's it from my side. Thanks.
Thank you.
Thank you. The next question is from the line of Rohit Ori from Progressive Shares. Please go ahead.
Hi, sir. 2 or 3 questions. The first one being related to the EBITDA margins. If we see that over the last 9-10 years, we've been at an average of 10.5% EBITDA margins or so. So what are these factors that give us this confidence that going forward we will try to reach around 14% or maybe that kind of range of EBITDA margin in the next 2 to 3 years or so?
So in this, as I explained, that major impact is coming from the change in the sales mix. So because that always it is very difficult to negotiate or to work with the two-wheeler because the commodity prices are going up. So now we are shifting the main shift of the business from two-wheeler to the passenger as well as the commercial vehicles. That is one, and on the other side we are moving towards the global business. So where we are negotiating the good prices from the customers when we made a comparison from the existing customers in India. So there is the major opportunity to improve our margins, as well as the second is that the growth trend. So definitely the economy of scale, that benefit we should get.
Okay. So then my next question is that if you consider the customer order book anticipation versus the real world and reality as to what we work with our capacity, what exactly is the conversion ratio? Assuming that if the order book is 100 rupees, then what sort of conversion can we do over like a year's time?
Not understood. This means converting into the sales you're talking about?
Yeah, converting into sales revenue, yes.
Oh, this what we are talking about, the order book, it depends on what we are giving based on the schedules, yearly schedules they are given. Because we have already secured the orders from them. Customers has already given the purchase order. So only the lead time depends on the part and when there is a launch of the vehicle. So it may be 1 year or maybe some customers like JLR, so they generally go for the 2 years lead time.
Okay. So is it fair to assume?
And there is an increase in the volumes year on year they go. So in that fashion, all our new order book, what we are discussing or we are declaring in this Concall, so it is based on the schedules what we receive from the customers.
Okay. So is it fair to assume that going forward you can grow at around 18-20% kind of CAGR growth over the next 5 years or so?
Hope so, with your blessings.
I mean, like, of course, but then do we have the capacity? Because last I believe that we spoke about the greenfield.
As I explained, capacity, we cannot directly correlate with the order book and the capacity, existing capacities, because depends on the requirement of the capacity means the kind of machine, depends on the requirement of the product. So we are maybe 50-60% of the common things. So we can utilize like the melting or casting, but some different requirements for individual product. So that too, there we have to invest. So
true. Good.
And Rohit, also as a part of the operational improvement, we also go for more capacity utilization by increasing the number of cavities, by putting more load on the machine, going for the higher weight parts. So those improvements also we do, so that we can generate more revenues with the same capacity.
So I understand the part where we are reducing certain parts but getting newer parts every year. But then the thing is that do you think that going forward you'll be making use of the property which is at Khed, because the greenfield project which was there in the past, it was delayed and it was a blessing in disguise that it got delayed. But then going forward, do you think that you will be investing into this greenfield capex?
At this moment, we have not planned this, because you know that when we go for the greenfield project, So we have to start with the huge investment as well as on the fixed cost side.
Correct.
And then to turn around that location, I don't know, maybe need 3 to 4 years. So we always more focus on how to increase our output or improve our capacities from the existing facilities. So that even for the 2,000 crores, what we are talking for 25, 26, our plan is to deliver from the existing facilities.
Correct. You're still sweating the assets which we have right now.
Yes.
Okay, sir. That helps. That helps a lot. Thank you, sir. Thanks a lot.
Thank you.
Thank you very much.
This was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter. Thank you very much.
Thank you very much. On behalf of Alicon Castalloy Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.